Welcome to Griffonomics. Today we're diving into a comparative analysis of Quest Diagnostics and Labcorp Holdings, trading under the tickers DGX and LH. Quest is executing a highly efficient volume harvesting strategy that pairs Google Gemini artificial intelligence with consumer direct platforms to drive immediate bottom-line cash flow compounding. Conversely, Labcorp's capital-heavy regional roll-up playbook drags on near-term cash metrics, but its multi-billion-dollar pharmaceutical trial backlog completely insulates its underlying architecture from upcoming federal reimbursement adjustments.
Yeah.
So imagine for a second walking into a totally sterile clinic for a routine like $38 cholesterol check.
Yeah, we've all been there.
Right. You sit down, the needle goes in, you watch the dark red liquid fill a plastic tube, and you leave with a piece of cotton taped to your arm. It is just this minor, completely forgettable inconvenience.
Yeah.
But to Quest and Labcorp, that single vial of blood is the raw fuel for a $90 billion financial engine. As an investor or an analyst, or frankly, just a curious learner, you might look at these two companies and see identical national laboratories performing identical commoditized services. Today's mission is to basically strip away the regulatory jargon and uncover the massive divergence in their underlying financial engines, their technological pipelines, and their risk profiles.
And the stakes here are really, they're structural to the entire American healthcare system.
Yeah.
Because these are the two dominant players controlling the infrastructure backbone of how medicine is practically applied in this country. They process the data that dictates, whether a patient gets a life-saving surgery or whether a new Alzheimer's drug clears the FDA, and whether an insurance company is actually willing to foot a $100,000 medical bill.
Wow. So it's everything.
It's everything. And what makes their Q1 2026 earnings so revealing is that they showcase fundamentally different philosophies on how to grow in an era defined by artificial intelligence, advanced precision medicine, and frankly, the constant looming threat of federal price cuts.
Right.
So they might have similar logos on similar strip mall storefronts, but under the hood, they are engineering entirely different corporate machines.
Looking at this Q1 financial and operational audit, the first thing that really jumps off the page to me is Quest's top-line velocity.
Oh, absolutely.
They posted a 9.2% net revenue improvement, pushing them to $2.90 billion for just a single quarter. But the number Wall Street really latched onto was their volume growth. Quest reported that their total volume measured by the number of test requisitions, basically just the number of times a doctor ordered a test, increased by 10.9%.
It is huge.
Right. And I have to play the skeptic here. In a mature legacy healthcare business, a 10.9% organic volume growth rate looks almost too good to be true. Are that many more people suddenly getting sick, or is there some massive accounting distortion hiding in that math?
Well, the skeptic is totally right to question it because a 10.9% organic jump in a mature market usually points to an anomaly. And in this specific case, we have a massive one. Roughly 7% of that organic growth came entirely from just two specific massive onboarding events.
Oh, really? Just two?
Just two. The first one is their new collaborative lab solutions relationship with Corewell Health. And Corewell is this sprawling, highly dominant health system in Michigan.
Got it.
When a national player like Quest takes over a hospital system's lab, they don't just sign a piece of paper. They physically take over the supply chain, the routing, the equipment, and often transition the hospital's employees straight onto the Quest payroll.
Wow. So suddenly, every single blood draw from every single clinic associated with Corewell is instantly ported onto Quest's balance sheet.
Exactly. It's an instant injection of millions of vials of blood. And the second major event involves the rapid ramp-up of testing for independent dialysis clinics. Specifically, thousands of locations operated by Fresenius Medical Care.
Ah, dialysis. So that's a very specific kind of testing.
Yeah, dialysis testing is this fascinating logistical beast. Patients with end-stage renal disease require constant, rigorous monitoring. They're typically treated 3 times a week, which requires a highly rigid laboratory testing schedule.
I imagine that's a lot of recurring volume.
Oh, it is. Heavy panels at the early part of the month, the middle, and the end. So Fresenius made a strategic decision to close down 2 of their own internal laboratories and transition all of that high-frequency volume over to Quest. That contract alone is slated to be a $100 million business for Quest in 2026.
Wow. Which means if you strip out the Corewell Hospital takeover and the Fresenius dialysis influx, Quest's true underlying organic utilization volume grew at a much more normalized 3.8%. That is still a very healthy number. but it paints a completely different picture than the 10.9% headline. And I think this brings up a massive red flag regarding their profitability. Because all this new partnership volume actually caused a 1.3% contraction in their revenue per requisition.
Right.
They are processing millions of more vials of blood, but they are getting paid slightly less on average for every single one of them. Why would a company intentionally take on contracts that dilute their average check size?
Well, the answer lies in the business mix. The Corwell and Fresenius contracts brought in a tidal wave of routine clinical panels. These are high-volume but lower-priced, low-complexity tests. Think basic metabolic panels, standard complete blood counts.
The cheap stuff.
Exactly. When you flood the system with $30 tests, your overall average revenue per test mathematically has to drop, even if your total cash collected goes up. If you isolate the core business and remove those two specific partnerships from the equation, Quest's baseline revenue per requisition actually expanded by about 2.5%.
Oh, I see.
Yeah, so they are playing a volume harvesting game, betting that their centralized infrastructure is so ruthlessly efficient that they can still squeeze a solid margin out of those lower-priced routine tests.
Okay, so while Quest is flooded with these routine dialysis panels, Labcorp's top line tells a very different story. Labcorp didn't have a massive hospital takeover to juice their numbers. They reported a 5.8% enterprise revenue growth, hitting $3.54 billion for the quarter.
Right.
But the mechanical variables protecting Labcorp's revenue are fascinating. Their growth wasn't driven by a sudden surge in people getting their cholesterol checked. Their Biopharma Laboratory Services segment, the division that partners with pharmaceutical companies to run clinical trials, grew by 8.2%. And the sources explicitly note this was significantly insulated by a $40 million foreign exchange tailwind.
Yeah, and that foreign exchange piece is a crucial lever for Labcorp because their clinical trial business is heavily global. When a massive pharmaceutical company runs a trial for a new cancer drug, they are testing patients in Europe, Asia, and South America, not just the U.S.
Right, it's an international operation.
Totally. So when the U.S. dollar softens against certain foreign currencies, the revenue Labcorp collects overseas translates back into more U.S. dollars on their quarterly income statement. It is a mathematical cushion that Quest, which is almost entirely domestic, simply doesn't have.
But on the flip side, Labcorp's core diagnostics volume, the actual foot traffic of everyday patients walking into clinics, was slightly constrained. They only saw a total volume growth of 2.5%, and the management team explicitly called out a $15 million adverse weather drag in Q1 that kept people from going to the lab.
Yeah, the weather.
I mean, I always raise an eyebrow when corporate executives blame the rain for missing a target, a $15 million hit just from bad weather.
I know, it sounds like an excuse, but in the physical diagnostic world, it is a hard reality. Routine blood work is highly deferrable. If there's a massive snowstorm in the Northeast or severe flooding in the South, a patient will simply cancel their appointment for their annual lipid panel.
Because it's not an emergency.
Exactly. And often, they don't reschedule it for months. A deferred test in January might not happen until June, meaning that revenue completely vanishes from the Q1 ledger. It just highlights the vulnerability of relying purely on physical foot traffic.
This really makes understanding Labcorp's true profitability a bit of a maze. To reach their reported $508 million adjusted operating income, management backed out $127.1 million in operational charges from their GAAP baseline.
Yep.
Wait, hold on. They added back over $127 million to show Wall Street their quote-unquote real earnings. And the largest chunk of that is $75.6 million for something called definite-lived intangible asset amortization.
It's a mouthful.
It sounds like corporate accounting magic. What exactly is an intangible asset in the blood testing world?
So it is basically the financial ghost of their aggressive growth strategy. Over the last decade, Labcorp executed a regional roll-up playbook. They bought up dozens of smaller regional laboratories and hospital outreach programs. When you buy a regional lab, you aren't just buying their physical microscopes and centrifuges, you are buying their customer relationships.
Like the local doctors.
Exactly, the loyal network of local doctors who send them tests every single day. Those relationships are classified as intangible assets. Accounting rules require Labcorp to slowly write off or amortize the value of those purchased relationships over a set period, typically 15 years.
Okay, so it's a non-cash charge.
Right. It is a non-cash accounting charge that depresses their DAP earnings. By adding it back, along with $13 million in non-capitalized costs for their Launchpad process improvement initiatives, management is telling Wall Street, look past the historical accounting noise and look at the actual cash this machine generates today.
I see. It's kind of like a duck on a pond. Top-line revenue looks like a duck gliding smoothly across the water, but underneath, the accounting math, the mix shifts, the weather drags, the FX tailwinds is just paddling wildly.
That's a great way to look at it.
So if Quest's massive volume spike is heavily diluted by lower-paying routine tests, and Labcorp is spending fortunes rolling up regional labs to capture local doctor networks, we have to look under the hood at the unit economics. How does a mega laboratory actually make money on a single vial of blood? Because if they are charging $38 for a lipid panel, the margins must be razor thin.
Oh, the margins on the first test are incredibly thin, largely because of the sheer weight of the fixed infrastructure costs. In the industry, a patient visit is called an accession. Let's walk through the physical reality of an accession.
Let's do it.
A patient walks into a clinic. You have to pay the hourly wage of the phlebotomist who draws the blood. You have to pay the lease on that clinic space. Then, a specialized logistics courier drives a van to pick up that sample. You are paying for the van, the gas, the courier's salary, and the specialized temperature-controlled cooler.
That adds up fast.
And we aren't done. Finally, the van arrives at a massive centralized processing facility where technicians unpack, sort, and prep the vial. All of that happens before a single drop of blood is actually analyzed. Exactly. The only additional cost to run a second or third test on that same vial is the microscopic amount of variable chemical reagent used in the analyzer machine.
Think about the last time you went to the doctor for an annual physical. They didn't just order a basic metabolic panel. They likely checked your vitamin D levels, your thyroid function, your iron stores, maybe an advanced cardiometabolic risk marker.
Right.
To you, that is just thorough preventative medicine. But to Wall Street, that behavior is the corporate holy grail. It perfectly explains Quest's structural margin progression over the last decade. Back in 2015, they averaged roughly 3.5 tests per requisition. Today, they have systematically expanded that density to 4.3 to 4.4 tests per requisition. Every additional test added to that single needle stick is pure financial leverage.
And Labcorp is attacking this exact same economic engine, but from a slightly different angle. They aren't just trying to maximize the raw number of tests. They are aggressively pushing high-value, specialized testing, what the industry calls the esoteric mix.
The esoteric.
Yeah. Currently, esoteric testing accounts for roughly 40% of Labcorp's total diagnostics revenue.
What makes a test esoteric compared to a standard routine panel?
It comes down to complexity and equipment. A routine test, like a lipid panel, is essentially automated chemical analysis. You load 1,000 vials into a machine, and it spits out the results. Esoteric tests involve advanced scientific processing.
Like what?
Things like molecular diagnostics, flow cytometry, or complex genetic sequencing. These tests require highly specialized PhD-level scientists to interpret the data, and they utilize incredibly expensive, specialized equipment. Because they are highly complex and target severe disease states, they command premium reimbursement rates from insurance companies. By layering these premium esoteric tests on top of the routine panels, Labcorp managed to drive a price and mix increase of 2.6% in the quarter.
To use a physical analogy, the requisition density model operates exactly like the Amazon Prime delivery network.
Oh, how so?
Once that delivery truck, or in this case the logistics courier van, is already scheduled to drive to your house, adding a second or third small item to the cardboard box costs Amazon virtually nothing in shipping overhead. It makes those extra items incredibly profitable.
That's spot on.
But let me challenge this premise. Is there a ceiling to this density? At what point do insurance companies, who are ultimately paying the bill, push back on doctors ordering 5 or 6 tests instead of 2? They must have algorithms flagging doctors who overtest.
They absolutely do. Insurance prior authorization pushback is the primary friction point in this business model. Insurers will refuse to pay for secondary tests unless the doctor can prove medical necessity.
Right. They don't want to pay for unnecessary data.
Exactly. So to bypass that friction, Quest and Labcorp have to rely on proving clinical utility. They have to present hard data showing that adding these highly complex, expensive secondary tests to a single blood draw actually saves the healthcare system money in the long run by preventing a catastrophic, expensive hospital admission. Which means to truly capture that high margin growth, we have to examine the specific high science tests these companies are rolling out.
And that takes us directly on to the oncology liquid biopsy battleground. This is where the science transitions from standard medicine into something that feels, honestly, truly futuristic. We aren't just checking cholesterol anymore. We are hunting for microscopic fragments of cancer.
It's incredible. Let's perform a comparative audit of their specialized testing modes, starting with Quest's commercial rollout of the Haystack MRD test. MRD stands for minimal residual disease. It is a solid tumor liquid biopsy. Traditionally, after a patient undergoes surgery to remove a solid tumor like a colon cancer mass, the oncologist relies on standard CT or PE scans to see if they got all of it. But scans can only detect tumors that have grown large enough to be physically visible.
Which means by the time it shows up on a scan, the cancer has already significantly recurred.
Exactly. Haystack changes the paradigm entirely. Tumors shed microscopic fragments of their DNA into the patient's bloodstream. Haystack is designed to detect those trace amounts of circulating tumor DNA long before a physical mass actually forms.
That's wild.
And Quest is currently running a massive 14-site collaboration with City of Hope, which is one of the premier cancer research organizations in the country, to study Haystack's utility in clinical trial participants. Furthermore, they have deployed 40 dedicated commercial sales reps whose sole job is to educate and push this specific test to oncologists across the country.
Let's talk about the unit economics of a test like this, because it is staggering compared to a $38 routine blood panel.
Oh, yeah.
Quest has established a $3,900 baseline pricing for the initial Haystack test. And because this is about longitudinal monitoring, checking the patient every few months to ensure the cancer hasn't returned, they have established an $800 pricing tier for each subsequent monitoring test. But, I mean, you can't just invent a $4,000 test and expect Medicare to blindly pay for it.
No, you absolutely cannot. The crucial regulatory milestone here is Quest's technical assessment filing with MolDX, the Molecular Diagnostic Services Program. It is essentially the gateway to securing automated Medicare Advantage coverage. It's a highly rigorous technical review process. Quest reps are out in the field fighting for market share by showing oncologists real-world data where competing liquid biopsies from other companies gave false negatives, but Haystack's highly sensitive limits of detection successfully caught the recurring tumor fragments.
Oh, wow.
Yeah, and once they secure that MolDX coverage, that $3,900 revenue stream becomes significantly de-risked.
But Labcorp isn't just sitting on the sidelines watching Quest take the oncology market. They countered in Q1 with the launch of their own Plasma Detect tumor-informed assay. And they're casting a very wide net. This test spans breast, lung, and colon cancer indications.
They are. Labcorp acquired the underlying science for Plasma Detect through their acquisition of assets from Invitae, which is a major player in medical genetics. They are leveraging highly sensitive assays specifically targeted for stage I through stage 3 breast and non-small cell lung cancer, as well as stage 3 colon cancer. But, oncology is just one front in this high science war. The other massive battleground is neurology.
The Alzheimer's testing boom. For decades, the standard protocol for diagnosing Alzheimer's was a highly expensive, deeply cumbersome PTT-CT scan, or an invasive lumbar puncture to draw spinal fluid.
Terrible options.
Right. And Quest is actively disrupting that paradigm with their AD Detect portfolio. They're utilizing advanced mass spectrometry to identify specific blood biomarkers. We're talking about isolating amyloid beta 42 and 40, as well as pTau217 and pTau181 proteins directly from a standard blood draw.
Mass spectrometry essentially acts as a highly advanced molecular scale, identifying proteins based on their exact mass and charge. By isolating these specific tau and amyloid markers, Quest is achieving up to 90% sensitivity with a simple blood test.
90%.
Yeah. Think about the physical reality of that shift. Instead of sending an elderly patient to a specialized imaging center for a terrifying multi-$1,000 radioactive brain scan, a primary care doctor can simply order a blood test during a routine checkup. It completely democratizes access to early diagnosis.
But here is where the dynamic gets fascinating, because this is where Labcorp plays its ultimate trump card, their high-science biopharma pipeline. We noted earlier that their biopharma segment grew by over 8%. Labcorp supported more than 85% of all new FDA drug approvals last year.
Yep.
They don't just run the diagnostic tests for doctors. They actively partner with pharmaceutical companies to develop the actual drugs in the first place.
Which is the core differentiator of Labcorp's entire corporate identity. Through their Biopharma Laboratory Services segment, they function as a contract research organization, or a CRO. They are deeply embedded in the clinical trials. They utilize advanced pharmacometrics, which involves highly complex mathematical modeling to predict drug-to-drug interactions and dosage toxicity before human trials even begin.
So they are in from day one.
Exactly. They manage the logistics of testing tens of thousands of trial participants globally.
To put this in perspective, I think of it like this. Quest is the toll booth on the highway. They are highly efficient, collecting cash from every car that passes through their diagnostic network. Labcorp is the construction company actually paving the road miles ahead. Because Labcorp is running the FDA trials for the experimental Alzheimer's drugs today, they know exactly which diagnostic toll booths need to be built for tomorrow.
That's a perfect analogy.
They have an unparalleled view into the future of medicine. They know which therapies are coming down the pipeline years before commercial approval, allowing them to prep their testing infrastructure in advance. So I guess the question is, for an investor looking at long-term durability, is it better to own the highly efficient toll booth or the construction company building the future roads?
Well, that tension is the core divergence in their valuations. Wall Street historically tends to reward Quest's pure-play diagnostic distribution model with a higher valuation multiple because it is lean, highly focused, and incredibly cash-generative.
Right, it's simpler.
Labcorp's scientific depth as a CRO is undeniably powerful, but maintaining that clinical research infrastructure, the global trial logistics, the specialized modeling software, the PhD scientists, it is incredibly capital intensive. And here's the reality both companies face. Managing millions of these highly complex molecular level tests requires an unprecedented scale of operational precision.
Which brings us to the operational wall they both hit. You can invent a miraculous $3,900 liquid biopsy. But if a human pathologist is still squinting through a glass microscope for 30 minutes to confirm the results, or if hospital administrators are manually typing patient data across incompatible software systems, your margins collapse entirely.
Yeah, the labor kills the margin.
They had to take the human friction out of the loop. Both companies are now executing massive technological overhauls, turning to enterprise artificial intelligence and automation to manage costs inside and outside the lab. Let's look at Quest's Project Nova.
Okay, so Project Nova is Quest's massive multi-year initiative to completely transform their order-to-cash processes.
Order-to-cash.
Yeah, in healthcare, order-to-cash is the entire labyrinthine journey from the moment a doctor clicks order lab test in their computer to the moment the insurance company finally cuts the check to Quest.
And I imagine that's a mess right now.
A total mess. Currently, hospital records are incredibly fragmented. A doctor's local software often doesn't speak cleanly to Quest's billing software, leading to missing diagnostic codes, denied claims, and just millions of dollars in delayed or lost revenue. Project Nova is a partnership with Epic Systems, the dominant electronic health record provider, to standardize this into a single, automated operational flow.
But rewiring the technological backbone of American healthcare is painfully expensive. Management warned investors that this epic implementation introduces a significant 25-cent diluted earnings per share headwind for 2026.
Cryptic hit.
With over 60% of those expenses heavily backloaded into the second half of the year, it is a severe short-term margin hit for the promise of long-term automation efficiency.
And Quest is mirroring that automation inside the physical lab as well. They are deploying machine learning vision tools to completely replace manual microscopes for reading digital cytology slides. Instead of a cytotechnologist manually scanning a glass slide looking for abnormal cells, a high-speed scanner digitizes the slide, and a machine learning algorithm flags the suspicious areas instantly, vastly increasing throughput.
Wow, and Labcorp is deploying a very similar strategy with their PathAI digital pathology framework. They're aggressively moving away from physical glass slides, fully automating their manual histology arrays. Pathologists can now review high-resolution digital scans remotely from anywhere in the country.
Exactly.
They're applying predictive machine learning models to these images to enhance cancer diagnosis accuracy and drastically cut turnaround times. This is all scaled through what Labcorp calls their Launchpad process improvement initiatives, which are designed to systematically hunt down and eliminate manual inefficiencies across their network.
But the AI deployment outside the lab, specifically in how they handle data, is where Labcorp is making a massive leap. They recently announced an agentic AI partnership with Amazon Web Services and Datavant.
Wait, what exactly does an agentic AI do in a clinical trial setting? What does it mean to automate patient matching?
Well, the single biggest bottleneck in developing a new drug is finding the right patients for the clinical trial. If you are testing a highly specific Alzheimer's drug, you need to find patients with a very specific genetic profile at a specific stage of cognitive decline who haven't taken exclusionary medications.
Needle in a haystack.
Exactly. Historically, trial coordinators had to manually dig through thousands of fragmented medical records to find 10 viable candidates. Labcorp is using AWS AI models to ingest and analyze their massive repository of real-world clinical data. The AI acts as an autonomous agent, instantly cross-referencing millions of decentralized patient files against complex trial criteria, radically speeding up recruitment for Alzheimer's and oncology trials. It is a B2B AI deployment designed to shave months or even years off drug development timelines.
Meanwhile, both companies are fiercely competing for the end consumer using generative AI. Quest rolled out their AI companion, which is powered by Google Gemini, directly into the MyQuest app.
Yeah.
Because the problem with traditional lab results is that they look like a spreadsheet of Greek letters.
Nobody understands them.
Exactly. The AI companion translates complex lab values into plain English and tracks longitudinal health trends so the patient actually understands what their blood work means. And the adoption is striking. They saw 350,000 patient engagements in just the first quarter of 2026.
That's huge.
Labcorp countered with the MyLabcorp app, which is powered by an OpenAI reasoning engine. It links real-time lab values with guideline-based educational modules for cardiometabolic, mental, and kidney health.
Both of these AI deployments act like an administrative bulldozer, clearing away the red tape and medical confusion that has historically kept patients disconnected from their own health data.
But with both companies utilizing off-the-shelf large language model providers Quest using Google Gemini, Labcorp using OpenAI, is AI actually a unique competitive moat for either of them? If anyone can buy access to OpenAI, is this just a new, expensive baseline cost of doing business merely to survive in 2026?
That's a great question, but the large language model itself is not the moat. It is simply the reasoning engine. The true insurmountable moat lives in the proprietary data they are feeding into those models.
The blood data.
Right. Google and OpenAI supply the computational logic, but Quest and Labcorp exclusively own the longitudinal historical blood data of hundreds of millions of Americans spanning decades. You cannot replicate a 20-year biological history of a patient population. Whoever integrates that exclusive historical data most seamlessly into the physician's diagnostic workflow and the consumer's pocket will ultimately win the AI arms race.
Yeah. But funding these massive technological overhauls, paying for Epic integrations, AWS Agentic AI, and Google Gemini licenses, requires tremendous capital. And the way these companies structure their balance sheets reveals deep differences in their financial vulnerability to the unpredictable U.S. health insurance market. Let's dissect Labcorp's structural balance sheet power first, specifically circling back to that Biopharma shield.
Sure. So Labcorp ended the first quarter with a massive $8.64 billion biopharma backlog. This is not projected demand. This is contractually secured revenue from pharmaceutical companies who have hired Labcorp to run their clinical trial testing over the coming years.
The mechanics of that backlog provide incredible visibility. Out of that $8.64 billion, $2.69 billion is contractually scheduled to convert into actual revenue over the next 12 months.
And that $2.69 billion represents roughly 25% of Labcorp's entire projected business for the year. The strategic value of this backlog cannot be overstated.
Because it's guaranteed.
Exactly. This revenue is completely insulated from the chaos of commercial health insurance volatility. A pharmaceutical company funding an FDA trial does not require prior authorization from UnitedHealth or Aetna to run a test. This revenue isn't impacted by sudden Medicare rate shifts or denied claims. It is a concrete, contractual B2B shield protecting a full quarter of their enterprise from the friction of the U.S. insurance machine.
Let's contrast that fortified shield against Quest's economic engine. Quest operates with a lighter total debt position, $6.4 billion, compared to Labcorp's heavier $7.2 billion. Because they aren't funding massive clinical trial infrastructure, Quest offers a superior dividend yield architecture, returning cash directly to shareholders, which makes them highly appealing to stability-focused long-term investors.
Right.
And Quest manages their insurance payer vulnerability differently. They focus on maintaining a lower bad debt risk profile by aggressively capturing cash pay volume directly from the consumer.
Quest recognized that dealing with insurance companies inevitably leads to bad debt write-offs. When an insurer denies a claim or a patient refuses to pay their high deductible, the lab simply has to eat the loss. To bypass this entirely, Quest leaned into consumer health integrations. Through platforms like QuestHealth.com and various telehealth partnerships, patients can directly order their own specialized wellness panels.
You just go online, select an advanced cardiometabolic panel, and swipe your credit card before you even walk into the patient service center.
Exactly. Quest generates immediate, high-margin cash flow up front. There is no waiting 60 days for an insurance adjudication, no prior authorization fights, and mathematically zero bad debt write-offs because the cash is secured before the needle even touches the arm. It is a highly efficient way to de-risk a portion of their revenue.
So if we look at their overarching capital structures, we have Labcorp, which looks like a heavily armored diversified mutual fund, and Quest, which is operating like a highly tuned, pure-play sports car. But I have to push you on Labcorp's capital allocation strategy. They spend heavily on acquisitions to feed their regional roll-up strategy. They deployed $202 million in Q1 alone just to buy regional labs and hospital outreach programs. That constant M&A activity heavily drags down their near-term free cash flow. Wall Street often applies a conglomerate discount to companies that try to do too many things. Is Labcorp's conglomerate discount justified, or is Wall Street punishing them for building a necessary fortress?
Well, Wall Street inherently punishes complexity because it obscures near-term cash generation. Labcorp's dual-headed model running a sprawling clinical diagnostic network alongside a massive global pharmaceutical research operation requires intense, continuous capital expenditure.
It's expensive to be everything.
Exactly. To run a CRO, you have to maintain global logistics cold chains, you have to fund phase 3 clinical trial management software, you even have to maintain specialized animal research facilities for early-stage toxicology testing. That is incredibly expensive overhead that Quest simply doesn't carry. So yes, the drag on near-term cash metrics and the resulting conglomerate discount are mathematically real. However, Labcorp's fundamental argument is that the U.S. healthcare system is inherently unstable. When the inevitable regulatory shocks hit, when insurance companies squeeze margins, that diversified contractual CRO fortress is exactly what investors will wish they had.
Which brings us to the ultimate synthesis of this deep dive. We've audited the top-line financials, we've unpacked the unit economics of requisition density, we've explored the high-science battlegrounds of liquid biopsies, and we've weighed the balance sheets. Let's synthesize the final investment case and deliver the ultimate locator's verdict.
Okay, the final verdict synthesizes down to this core divergence. Quest Diagnostics operates as a highly efficient, focused growth utility. They are leveraging their pure-play diagnostic infrastructure to harvest volume at maximum efficiency, utilizing AI and consumer direct platforms to push immediate cash flow straight to the bottom line.
Right.
Labcorp Holdings, conversely, operates as a diversified long-term defensive shield. They utilize their capital-heavy biopharma CRO business and multi-billion-dollar backlog to protect their underlying architecture against the inherent regulatory shocks of the U.S. healthcare system.
But neither of these corporate machines is bulletproof. Both are staring down some severe macro execution risks that threaten to derail their trajectories. Let's break down the primary threats on the horizon. The most immediate systemic threat is the January 2027 PMA cliff.
The PMA cliff.
Yeah, PMA stands for the Protecting Access to Medicare Act. Let's explain why this act exists. Historically, Medicare looked at the lab testing market and realized they were often paying significantly higher rates for routine tests than private commercial insurers were paying. PMA was designed to force labs to report the lower rates they charge private insurers, and then Medicare mathematically pegs its own reimbursement rates to that lower market average.
And that data reporting mechanism triggers a massive cliff. If the upcoming PMA data reporting goes into effect as scheduled in January 2027, it threatens to trigger systemic clinical laboratory fee schedule cuts of up to 15% across hundreds of high-volume test categories.
15% is huge.
A 15% immediate haircut on core Medicare revenue is a devastating blow to the operating leverage we discussed earlier. The entire laboratory industry is aggressively lobbying Congress to pass the Results Act, which would freeze these cuts and reform the reporting structure. But right now, it remains a massive looming risk for both DGX and LH.
Alongside the PMA cliff, both companies are fighting an ongoing 30 basis point volume headwind caused by Affordable Care Act, health insurance enrollment churn. As millions of people transition between various health plans
or temporarily drop coverage due to Medicaid redeterminations, it creates localized gaps in diagnostic utilization.
Yeah, people wait to get tested.
Right. A patient without active coverage defers their routine testing, which mathematically drags on total volume. And just as a quick reminder to our listeners, we're reporting on this ACA policy impact purely impartially, strictly as a mathematical volume headwind documented in the financial filings, without endorsing any political viewpoint surrounding the legislation itself.
Finally, we have to look at the aggressive near-term margin compression on Quest's hospital collaborative contracts, specifically the Corewell Health takeover. We noted earlier that Corewell is bringing in a massive wave of volume, but management confirmed a harsh reality. Because of the massive initial onboarding friction, the physical logistics of taking over a hospital's entire laboratory infrastructure, retraining employees, and integrating incompatible software, that specific contract will operate at a severely depressed, low single-digit margin.
They explicitly cited margins hovering between 3 and 4% throughout the entirety of 2026.
Exactly. It won't be until early 2027 when Quest successfully opens their new, centralized 51% owned Mega Lab joint venture in Michigan that they can fully consolidate the testing volume. Only then will the margins on the Corewell contract scale back up to Quest's enterprise average. It is the definition of absorbing short-term margin pain to secure a long-term dominant market position.
We've covered the accounting math, the AI deployments, the advanced biology of liquid biopsies, and the structural balance sheets. As we wrap up this comparative analysis, I want to leave you, the listener, with a final thought to mull over. We've spent the last hour dissecting Quest and Labcorp as diagnostic testing laboratories. But as these two giants push further into generative AI, as they harvest massive troves of real-world clinical data, and as they deploy proprietary algorithms for early disease detection, we have to ask a bigger question. In the next decade, will we still view Quest and Labcorp as laboratory testing companies? Or, by controlling the flow of our genetic and molecular information, are they quietly transitioning into the world's largest biological data brokers? And if they exclusively own the longitudinal data required to predict your future health, who ultimately holds the true power in the healthcare ecosystem of tomorrow?